You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey everyone, welcome back to another episode of Market Champions. Today, I've got Shrubbery Capital, so you can find him on Twitter at agnostock, so AGNOSTOXXX. So he's a portfolio manager. He pretty much runs his own fund at this point. So thank you so much for being on the podcast, Shrubbery. It's awesome to have you here.
Oh, it's so great to be here. I'm a big fan of the show, and I'm very flattered to be here because you had so many great guests lately. I don't know how I can, I don't think I can top it in terms of intellectuality, but maybe I can just top it in terms of being a bit fun.
Yeah. And speaking of fun, so today, we're doing this on the 5th of May. And so today, the NASDAQ is down a nice 5%. So, and yesterday we had the Fed meeting. So, what was your take when you saw Powell and when it comes to days like this, so how do you think about managing trades and looking for opportunity?
So I was very, very chilled because I have a big cash position, and you can see me. The fact that we're doing this on a down 5% day on the 5th day of the 5th month of the year shows me that I'm well positioned. So the way I see it is, we can get through a lot of lessons that I'm trying to share online as well, just to be kind of the voice of reason. Every king has a jester, and the jester is a guy who's telling him the truth. So I'm the Twitter's shrub. I kind of like try to tell them the truth to keep some people safe during this upcoming bear market. So the way I approach things like the Fed meeting is very simple. I don't know anything about what the Fed is going to do. I don't know. And if I don't know what the Fed is going to do, and I know that people are nervous, I just raise my cash positions to a point where I'm very comfortable. And I just sit back because you know what? I don't like to take binary risks when that's not my game. That's not my game. So I just sit back. So I want to take risks from a position of strength, and from a position where the risk reward is in my favor, and from a position where I don't need to stress about it. Like yesterday, I was even thinking of not watching Powell. So I just put a tiny call option on just so I sit and watch the guy. And look, when you have a 3-hour view of the world, like most fund managers, you get sucked in. You see the guy, you see the guy saying, so the CNBC guy asks him, so Mr. Powell, will you consider 75 bips rate rise? And he says, no. And like, we all knew it, right? The whole market knew that he wouldn't do a 75 bips rate rise on the next meeting. But suddenly the algos pick it up and they say, oh, this is very dovish, oh, blah, 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 blah. So the market is up 3%, sucks everyone in. And then the next day they read the actual press releases, the actual news played back. And everyone's like, oh my God, he's still going to do 50 bips. He's still going to do QT. And then boom, the market's down 5%. So basically the guys who bought yesterday up 3 are selling it down 5. So my lesson out of this is we're not in the market where you should allow yourself to be emotional or too involved or too short-term, because, you need to survive out of this. And actually, you're very lucky, and I'll try and give my worthless advice to you as we're going along. But I lived through 2000. So you're 18 years old, right?
Yeah.
So you are very lucky that you're going to go through this bear market when you're 18, instead of when you're 30 or 40, when you're going to be more confident and more arrogant, and you're going to be running a lot of money. So my advice to you is go through it, live it. You're very involved and you're really switched on. So you have to live through it, lose a bit of money as well. It's probably going to be better for you personally to lose money in this bear market. So when you grow up, you take the lessons with you. But look, the setup of the current market is it's probably one of the worst setups I've seen, because nowhere is safe. I think the best call I've made on Twitter and personally, and for my for the account I'm managing, was 6 months ago, or in September, where I started thinking that this looks a lot like the 70s in some way, that it has a potential to be a stagflationary environment. And back when I left my old fund, I threw away all the research I had, and the only piece of paper I kept on my desk was the returns per asset class in the 70s, because the 70s was like the toughest market to navigate. It wasn't 08, it wasn't 2000, it was the 70s. Even Buffett was down 50% in 74. And in the 70s, the market, everything collapsed, but energy outperformed and real estate outperformed, because it was a stagflationary environment driven by, the oil embargo didn't help. So I kept that on my desk. I tweeted that out in September. And then I actually was seeing the tightness in the energy market. So I went long energy. I was long from before, but I increased my energy allocation and my commodity allocation. And then obviously when the unfortunate invasion of Ukraine happened, that was the real kick to kickstart a stagflationary environment. And I was, very certain, because Europe is short energy, short commodities. So Europe was definitely going to go into a stagflationary environment. And having that position on inside, so I had, I tweeted out, I live tweeted my portfolio allocations, and, I was 50-60% long energy and commodities. I had some special sits, I had cash, and I was fully hedged against tech. So, that trade kind of helped me survive up to this point. With the NASDAQ down 20%, because the volatility of the NASDAQ was a bit too much, and I like to sleep well, I removed my short, foolishly maybe, but I increased my cash position. So the way I offset my hedges, I see cash as my hedge. And I have learned this after years of complex analysis and losing a lot of money, that the best hedge you can have is actually cash. This is not something that hedge funds can do, and it's a painful lesson to learn, but I'm going to repeat it probably 10 times in the next hour we're together, that cash is a hedge. It gives you optionality. The way you should think about it is like, imagine in 09, imagine if you were cashed up in 09, how much money you could have made in 2010. So it's the same thing here. You just have to have the cash, keep them on the side, and it's just very, very difficult for an excitable young man with, driven by testosterone to not deploy the cash while the market is going down. And this thing can last for 2 years. And this is the part that most people have trouble understanding. That sorry for going on along this way, but think about it this way, because you work with Mike Green, who's like an amazing person and super smart. I have so much respect for him. And also the fact that he recognized your potential shows that he's a value investor as well. so you guys have like, I'm actually not joking that the fact that he took you under his wing as well just shows that it's a great guy and sees potential in people. So you had $1 trillion of inflows since COVID. So that's a lot of money last time I checked. And you've had 30 billion of outflows in 2 weeks. So that tells me, if you unwind the whole thing, man, that can take a long time. But I don't think it unwinds the whole thing, because the Fed always pivots eventually. But who knows, right? It can last 3 months, it can last 6 months, it can last 12 months. We don't know. My philosophy in life is, I don't know. You have to basically, I'm going to, channel your inner shrub. You just don't know. You cannot know certain things. You don't know where, you don't know how long the bad weather is going to last or something, right? Certain things you just can't predict. So you just have to make contingency plans and preparations. And that's why, I like cash at this point in time. But again, I'll just mention one thing here about the temptation, because after all the years, I've been in this industry for 16 years now. The biggest lesson you will learn is to just control your emotions and be patient. And it's very, very difficult to do that. Very difficult. One of the best books, if not the best book on investing that I recommend to people, bizarrely, is Dostoevsky's The Gambler, which it just encompasses, it beautifully captures this gambling instinct that a lot of fund managers have when the adrenaline is high. And that's the part that you need to suppress. It's when, the guy sits on the roulette table and he just keeps playing and he keeps winning. And, he's like, oh, I could leave the table now, but actually, no, one more roll of the dice, one more roll of the roulette table. So it's exactly the same thing. It's like one more YOLO. So it's like, it's the same thing. It's the same thing. It's just like, that's why, the last few weeks, my trade, long commodities, short the rest, it's been working well. I've had to suppress my emotions to take it down from 100% down to 60% and just, sit back a bit. Can it last another 10 years? Yeah, of course it can. That's why I'm still 60% in it. But you just have to, control your emotions, sit back. I mean, if I was going to do it 5 years ago, I would have been levered 2 times doing it, not like in cash. So, long story short, we're in a very tough market. It pays to be in cash. Complexity is a killer. As I say, keep it simple, shrub, kiss. And then just sit back and, enjoy life as well. It's a reopening, you're going to have a great summer with a reopening. So sit back, chill, position yourself that you enjoy your time with your family and your friends in the summer. And don't stress about it. We could be down 20, 30% from here. Just the last thing that, just to kill the myth of the buy and hold crowd. And I don't have the numbers in front of me, but they always say, oh, if you missed the 10 best days of the year, you would have made 100% instead of 800%. But they don't tell you if you missed the 10 worst days. If you missed the 10 worst days, well, 1, you might be out of business, or 2, you did a lot worse. So that's why. Do I care about the buy and hold? No, it's not my style. I don't really care, to be honest.
And I will be sure to check out Dostoevsky's The Gambler. And speaking of commodities, just to start off with, so your base case is stagflation, right? And we can tell that from your Twitter. Your Twitter name is Shrubbery Capital, and so when it comes to sort of like the Federal Reserve's policy, so is there a point where you would get scared about a demand shock when it comes to commodities?
Yeah, so let's stick to commodities because it's just a very fascinating setup. Bear in mind I'm a generalist by background, but I have spent years in the commodity space, 2007-8. I've been to China around mines, I've been underground. So I know a few things, but I'm not a specialist. So commodities are a very strange beast because it's not a great asset class in some ways. It's very cyclical. And it was really driven by China from 2000 to 2007. And now I think, after the China slowdown, people kind of gave up on it in some way. And COVID was a bit of a wake up that to start something called the decarbonization and the energy transition. So it was always there, but COVID kickstarted the whole thing. So you have commodities and energy. So I'm going to talk about both. Commodities are a bit easier to understand because it's driven by China in some way. So half of the world's copper goes to China, half the world's this, half the world's that, half the world is like China, right? So that's oil is a bit different because it's a proportional to GDP. So China is like less than 20%. So commodities have gone through starvation of capital for a while now. And so I'm going to start with that. So the starvation of capital happened partly because of ESG, and that was specifically for the energy side. So ESG basically forced banks to reduce lending, it forced fund managers to reduce capital allocation, and it forced companies to become to reduce certain projects, and also increased a lot of protest by the green, green environmental organizations, and the environmental standards have tightened a lot. So you had starvation of capital from ESG, but you also had stricter regulation. So put that together, plus China slowing down, because the big buildup of China happened really between 2000 and 2007. That was a big one.
Yeah.
And then the stimulus from the GFC. So put all that together, and you had this, this starvation of capital. But in the energy space, it was actually even worse. I think the missing capex in energy was like $1 trillion over the last 10 years or something that was cut. I mean, if you want the prime example of this was BP. BP stopped investing in oil. They had a 700 people exploration team. They fired them all down to 100, and they told them to go and work on wind farms. I mean, it's like madness. They're just shifting down, just shrinking down and just focusing on green. So you have this setup where you have a starved industry, slow down, no one cares, and then suddenly you have COVID and you have the energy transition. So that's a bullish theme that comes on top. And then you have on top of it, you had the Ukraine war. And that was the big moment that squeezed a lot of bottlenecks in there. So because as China is a consumer of 50% of everything, Russia was a producer of 20% of everything in some ways, like nickel. So you created a further squeeze on that. So you have this price increases and everything. Now, the thing about that, a lot of people that were not invested before in mining, they don't understand. They took the Russia-Ukraine thing as a one-off, and I didn't see it like that. I saw it that Russia did something terrible, atrocities, and Russia is going to be sanctioned. Like you look at the previous sanctions around the world, Iran since 1979, Venezuela 2014, North Korea forever. So these sanctions on Russia could stay for a long time. And they could get extended not only because people say, well, China's going to buy the Russian thing. Well, actually, maybe the sanctions become even stronger. So you have tightness. You have a lot of tightness in supply. And demand was so far driven by the reopening and energy transition. Now, this is the current setup. So just to summarize, because you have a supply without investment, and you have demand from a big theme. And you have supply shock as well. Now, let me step back 1 second. So people tell me, well, it's not going to be a super cycle because I'm still invested in this, right? I'm invested in this. Is the part of the cycle. I have like 60% of my portfolio is still energy commodities. So this is the part of the cycle that I would actually sell everything, because these are cyclical commodities. I mean, there's a cyclicality in these things. So I lived through 2008, and I was long mining in 2007, 2008. But we sold everything before shit hit the fan, because we were short subprime at the time. We kind of saw the demand destruction approaching. And back in 2008, there were bottlenecks in the oil price. Oil went to 150. So the market was collapsing. We had bear stearns. And oil still went to 150. So I'm playing here for the same kind of scenario as 2008, because now the tightness I see in the markets is worse than 2008. So you have a very strange situation where you have worse bottlenecks than 08, in some cases much worse. And we're fearing about demand, but we're not seeing the demand destruction yet. So my bear case is demand destruction, like 08. So now I'm seeing it this way. Shanghai is still closed.
Right.
They have to reopen. That's the first thing. The Fed has tightened, but come on, I mean, we have inflation of 8% and we have rates of like 1%. It's a joke. It's not like tightened already.
Exactly.
And then the big theme. Let's do the big theme, because again, I'm challenged on the super cycle theory, which I'm not even sure it's going to be a super cycle, but I'm still invested. So I'm exploring, because no one's actually saying that there could be another super cycle. So let's put it this way. The last super cycle I lived through was China, which there was the urbanization of China from 2000 to 2007. And that cost $15 trillion. If we decarbonize, which is, I think it's in everyone's interest to decarbonize, and we do the energy transition, the shift to electric vehicles, then Goldman's estimates that decarbonization to cost 1 China for this decade, and 2 Chinas if you include the next decade. So you're talking about $30 trillion of investment in the next 20 years. If you do that, we need, let me see how much we need. I have what UBS estimated to be 2 times the current level of nickel demand. So nickel demand, 2 times the current level of production, copper, 1.5 times the current level of production, cobalt 3 times, and lithium 11 times. And the deficits, you hit them from 2023 to 2024. Okay, so we're not talking about like science fiction.
Yeah.
And this is assuming we don't have a deep recession, okay? So the only thing that saves us is actually a deep recession. This is the paradox, that we would actually, the only way we can kill the super cycle is if we actually just say, you know what, we shouldn't buy Teslas this year. We should keep our old car going. So we basically say, you know, let's just put a pause in the decarbonization. And, you know, let's add a few other Twitter characters in the equation. So there's a very smart marsupial that's on Twitter. He tweets, is actually a marsupial that can tweet. His name is the yellow koala at Yellow Lab. So he said, he presented a theory called the eucalyptus paradox, whereby the paradox is that we need all these metals, but we refuse to mine them.
Right.
And if you, so you basically go and see what, you know, every administration in the world is doing. And they say, you know, they say, oh, we need lithium. It's like, okay, well, are you going to give a permit for lithium? Or it's like, oh, we need uranium. It's like, well, hold on, you have a massive deposit in Virginia and you just banned mining uranium in Virginia. Or, you know, we need copper. It's like, well, when was the last time you gave a copper permit? So this is the eucalyptus paradox. It's basically that we need all this stuff, but no one's doing anything about it. And we expect Africa to go and do it. Now, I'm going to introduce my theory, my new theory that I've been thinking about, and I will present it for the first time to your audience.
Let's go.
So this is like a world first, which is going to supplement the eucalyptus paradox. And I'm going to call it, I've been thinking a lot about this, so bear with me. I'm going to call it Shrub's Commodity Cycle Climate Conundrum. Or maybe I'm going to call it, yeah, or maybe I'm going to call it Shrub's Commodity Climate Conundrum, and just stay with me for 1 second, because I've been thinking about this. So the climate is long-term trend, right? The climate is a long-term trend. Weather is a short-term phenomenon. So the commodity cycles are like climate, like 10, 15 years long. You know, China urbanization, 10 years. Decarbonization, 20 years. So to build a copper mine, you need 10 years to build an offshore project, you need 5 to 10 years. So if you're going to feed the demand for that cycle, you need to plan 10 years ahead.
Wow. Yeah.
But look at the investors of these companies. They're short-term, some passive. This is not a big part of passive. It's 3% of the index. So to my greens, you guys know all about the passive, but it's only at 3% of the market. And private equity is not doing anything because, this is too volatile. And the people are investing is like hedge funds that have monthly issues, quarterly redemptions, blah, 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 blah. Private equity is not invested because, because commodities are too volatile. The weather, so the daily price moves of commodities are very, very volatile. They go up and down 20, 30% a year. So this is the commodity climate conundrum. How can you have short-term oriented investors that are only focusing on the weather and their Christmas bonus, make rational decisions for the long term and the benefit of the world in some way? The only way you solve the conundrum is when you have, an external force, a policymaker, to step in and fill that gap. That just basically says, and then this is actually what China did. The only country that did that was China, and actually maybe Norway as well in some way, because they had the China said, we're going to invest in this mine in Africa. They did the Belt and Road. They invested a lot in African mines. So China actually did this right. They were centrally planned. They realized that that they're short commodities, so they actually tried to solve shrubs commodity climate conundrum. Now, that's one thing. What about the Western world? It looks like our politicians are not doing anything about it. Our politicians are actually dealing with the eucalyptus paradox. They want the commodities, but they refuse to mine them. And then where do we come to? And this is I tweeted that prediction jokingly, but it came true. The only way you're going to fix this, the only way is if industry fills the gap. And I was like, if Elon Musk is short lithium, he should fund the lithium project. So I tweeted half jokingly that, Elon Musk is going to end up buying lithium projects to build himself because no one else is doing it. And he tweeted out, it's like, oh my God, we're short lithium. There's so much lithium in the world. Maybe we should invest in lithium mines. So this is where we are. We're in a very interesting situation whereby we're all concerned about today. And I think, as I said, today, based on the current situation, commodities are just a supply bottleneck because of Russia. But actually demand looks like it's going to roll over. And when demand rolls over, commodities get killed. So short term, I could get killed on my positions, but actually the conundrum is still there. Who's going to build all these things? So this is the very, very interesting situation we're in the commodity market. It's very, very tough.
Yeah.
But it's exciting.
It is exciting. And so you sort of talked about how there's a broader commodity super cycle, and then people are being focused on the weather versus what's actually going to play out over longer term. And when it comes to I think one thing that you mentioned was you're a generalist. So when it comes to some sort of specific niche, like commodities or natural resources, so how does a generalist actually become, say, acquainted or familiar? And how would you go about doing research as a generalist in this sort of niche market?
Yeah, sure. So I think the key trait of any good investor, and I shouldn't say I'm a good investor, but I've survived so far. The key trait is curiosity. Yeah. You have to love to read. You have to be curious, and you have to be, always looking for an angle and build a library in your head of ideas that could not, maybe they don't materialize for a while, So the way I approach it is I just spend time reading and I'm just prepared for when something happens. So for example, oil and gas. I had like in 16 years of my life of investing career, I hadn't invested professionally in oil and gas until summer 2020, after oil turned negative. It was the first time. I was reading about it. And I'm like, well, I don't like it. But I've spent the time when it mattered. I spent the time and effort to understand the industry to a degree. And there's a lot of good people. Actually, bizarrely, there's a lot of good people on Twitter that give a lot of information. Bison interest papers, for example, were like better than anything that any Wall Street bank wrote, for example, on some topics. So, use the information available, connect to people. There's so many. I found that especially for niches, I found there's better knowledge and better access to good people on Twitter than in Wall Street. And this is really, really interesting, especially for something like oil and gas and commodities, where a lot of people lost their jobs in the last 10 years, now are out of business. Twitter was invaluable. I mean, one example actually is tin. Tin is the most exciting commodity for me. I've been going on about tin
Tin bearing.
Yeah. So, but there's a niche community on Twitter called the Tin Barons, and there's some great people on it. Like Trader Pamplona is the leader of the of the niche in some way. Like he's been sharing knowledge for the last couple of years on the topic. But look, there's no analyst in Wall Street. There's no analyst covering tin. So tin was in. I'll give you the very quick summary. Tin is a small market. It's a very niche market. I didn't know anything about tin until 1 year ago, and some friend of mine actually said, there's a deficit of tin because Myanmar is a big producer and there's a coup in Myanmar. It's like tin. I've never looked at tin, so I spent time on looking at tin. So how did I approach it? Let's do. Let's see how I did it actually. So we start with because I'm an engineer by background, and one thing I really, really value is first principles, and I use first principles in my investing more than anything. So first principles, you start with supply demand. So do a simple analysis. Go to Google, see the supply demand of tin. The supply demand was quite simple. There were like 220,000 tons a year. And it was like almost half of it was China, then it was Indonesia, then it was Myanmar, and a bit in Australia and the Democratic Republic of Congo. And Indonesia had onshore mining and offshore mining. Their onshore mining was depleting, and Myanmar was in a coup. So you basically have, and tin was like at 15,000 at the time or something. So if you have a major, and then demand, and then I'll just touch the demand side. So demand for tin, 60% of the demand goes for solder for semiconductors. So it's a structural growth market because it's the only commodity that actually so much of it goes to technology. It's the thing that sticks your semiconductors together. So, and then you look at what's the value of tin on your smartphone? And your smartphone has 0.7 grams of tin. And that comes out to be like 3 cents. So it's like a tiny percentage of your phone's value. So if you think about it, step back and it's like, okay, well, that's a great supply demand picture. And then it's like, oh, that's like, why is only 3 cents? So like if Apple is, so if supply goes down 10%, how much is Apple or, or whoever, like Taiwan Semiconductor, willing to pay to buy tin? If it's 15,000, it's like, well, the answer is it can pay like 10 times more. It's still going to buy it, right? Because if it's like 3 cents a phone, and they're making like $30, so they're going to pay like 10 times more. So anyway, so the tin price went up to $40,000. So so from 15 to 40,000. But also part of that picture was to find the producers, and we identified two producers. It was one in Australia called Metals X, and one in the Democratic, and then Alpha Min, which we've been tin barons have been Alpha Moon. So anyway, so we found the two stocks, and that's actually how I found the tin barons on Twitter. And the analysis they did was like way better than anything else. So I'm a long-term holder in both. They've gone up
remarkably,
remarkably well, but actually, and AFM had a takeover bid as well. Well, I mean, it's got like it's in a process, but I still hold my Metals X because even at current prices, it's making like 30% free cash flow a year for a very strategic metal. It's got a net cash position, and take away, close your eyes and don't look at the share price. Compare what is trading against other segments. So lithium stocks trade at 10, 20 times EBITDA, and uranium stocks trade at 10, 20 times EBITDA. And this is a very scarce commodity that's very strategic, and it's trading at 3 times EBITDA. And so, I played the rare earths in 2012, and I had the same feeling as like, oh my God, there's only one company back then. Back then it was Linus, and then it was Molycorp. And it's like, well, they did 10 times by the time we got out, and then they collapsed again. But, why would I not hang on to a stock? I don't care about if there's a bear market. I really don't care if there's a bear market on this one. Because why would I sell if it's got net cash and makes 30% a year? Okay, say tin collapses, I make 10% a year. Oh my God. I'm not going to cry if mine price is good. But, the way I was half joking about something, thinking about supply and demand, about tin. And this is going to sound like a very strange analogy, but commodities is all about supply and demand. And demand sometimes can go through the moon, and sometimes it can just stay stable. Yeah. But when you have a supply shock is when you make serious amount of money, because the demand for semiconductors is it's going to keep growing strongly, but supply is a big thing. So I was thinking about this way, and it's a very strange way of thinking about it. Say you have 100 guys and 100 girls in a bar, and the guys have to buy a girl a drink to speak to the girl, and the price of a drink is $5 a drink. So take away a girl, and you have 99 girls and 100 guys. So there's 2 guys competing for 1 girl. What's the price of the drink? Probably goes up 6. Take away 10 girls, and there's like 100 guys and 90 girls. The price of that drink goes, from 5, it probably goes. So if you reduce supply of girls by 10%, but the price of that drink probably goes like, I don't know, 10. So it doubles. And if you take out more than that, well, it can become exponential. So
sorry, we just cut off. You were talking about how when production capacity is constrained and you see demand start to go up, then the price of commodities sort of non-linearly or exponentially rises, which is
correct. Exactly. And I mean, and take it today to the most important commodity in the world, which is oil, because people were getting bearish oil again, and I'm like, guys, here's a very simple fact. I mean, you have 100. It's back to our example. You have 100 million barrels a day supply and 100 million barrels a day demand simply. And then if you take out 2 million from Russia, which is what BP is guiding, that's going to happen in the next month, you've lost 2% of the world's supply. And then you have driving season starting in the US. Why would I be bearish in this setup? I mean, it's actually quite bearish for the market, but it's not bearish for oil. So, again, keep it simple, Shrub. It's all about supply, demand. Put down the numbers, and just that's where they are. So I think we're in a pretty bad place commodity-wise, and we haven't even touched upon the food side, because food is going to be a problem in the next 12 months for the same reasons. Fertilizers are very much controlled by Russia and Belarus. So it's going to be a stagflationary environment, which can last it could last for years, because I'm expecting this conflict to last, unfortunately, a long time. So we could have a stagflationary environment for years, and it's very tough to protect yourself in this environment. That's why it's good to have different perspectives. And actually, that's why I implore people to spend a lot of time thinking, listening from others, and learning. And I think on your podcast, I actually listened to Mike Taylor. He's a great guy. And I mean, and actually one interesting fact is when Mike is talking about the market, like he was super bearish, it shows how different people knowing different things may have the same conclusion, but play the market differently. So he was bearish, he was 40% net short, I think, when he was on your podcast.
Yeah.
And at the same time, I was, 50% long. So he was 50% short, bearish the market, and I was 50% short, 50% hedged, but actually long. But I was long energy and mining because I was bearish tech, but I was bullish on energy commodities. So he was seeing his buy because he knows the biotech and the side. So he was short all that stuff, whereas I was just short the Nasdaq because that's all I know. I was long my other stuff. So it's kind of interesting. Like that's why, on the education side, that's why your podcast series and others are very important. Is that it gives different perspective to people, and you have to be really open-minded at this point.
Got it. Yeah. Also, another thing when it comes to commodities and when it comes to thinking through stagflation. So one aspect of stagflation is inflation, and so stagflation is just high inflation and high unemployment at the same time. And so a lot of people have been talking about gold and gold miners when it comes to when it comes to stagflation and inflation. So what are your views on gold and gold miners?
So look, gold usually does very well in stagflation. And gold miners are a sector that whoever traded it knows it's one of the worst sectors to trade. Because, and I'll tell you my view. So right now, I don't actually own any gold. I have platinum. So I'm playing it via platinum. It's a much smaller market, and I think it's going to give me protection as a precious. Now, stagflation is an erosion of value. So you want something that acts as a store of value. And that's why real estate actually does well in nominal terms. And then gold, obviously, because gold was the ultimate store of value. So I'm probably going to start buying gold at some point, but because I have all that commodity exposure elsewhere, that's why I haven't bought gold yet. But I'll tell you one experience I've had with gold, which tells me when I have the shrub indicator of timing to buy gold. I'm gonna trademark that. It's the shrub indicator of timing when to buy gold. So the only time I bought gold, physical gold, to go and buy physical, was in 2008. And it's because I saw my boss, who was a very, very smart guy, that went up and levered himself 100% to buy gold when shit hit the fan. He went, it's like gold was 950. He levered himself, which was a lot of money. He had a lot of money. He levered himself and bought gold. And me as a young analyst, I'm like, oh my God, this guy knows something. Knows something as in, this guy's smart and he's doing the right thing. It's like, so I went and bought physical at 950, like actual piece of gold. And then gold went up to 1500. I sold it in end of 2009 or something. He kept it, it went to 1800. I felt like I was a complete schmuck, but actually it went back to 900. So the lesson of that. Oh, and by the way, during that period, copper went to the toilet in 2008. But afterwards, in 2009, copper massively outperformed gold. So although I made like 50% of my gold purchase, I would have made multiples if I bought copper. Fast forward to 2000, everyone was buying gold. You can guess what the shrub was buying. I was buying nickel, tin, copper. I was buying everything but gold. Yeah. So do I feel like I need to own gold physical now? To be honest, I actually feel like I should have some physical gold. So it's really not a bad time to be thinking about gold purchases. And people say, oh, but Bitcoin is the new gold, blah, 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 blah. Bitcoin, crypto, JPEGs, monkeys, nonsense. Gold is like, we're in the precipice of a world war and you're talking about JPEGs. I mean, geez, man, like talk about being stupid, seriously. We have a saying on the, on our Twitter feed, right? On the Shrubbery Capital Twitter feed is, don't be stupid. And when you have like, you're in the precipice of a gold, of a world war and like global stagflation and you're buying crypto, dude, 5,000 years of history, you buy gold coins, you don't buy like, and and let me just tell you this story because I thought it was a complete joke really. So I was with this private banker a few days ago and it was a very friendly setup. So nothing promotional. And the guy was telling me, oh, how do you think about markets? And I told him my view and he said, yeah, a lot of our clients are concerned about inflation. So they're allocated to equities and also crypto to protect themselves against inflation. And I'm like, what? And I just didn't want to continue the conversation. I just left it there. I just left it there. I was like, come on, man. I mean, you're a private banker and you're telling people to buy crypto to protect against inflation. I mean, seriously, let's just say it again. Talk about being stupid. I mean, I don't like to insult people, but I'm kind of like, because I have, I don't really have an agenda, so I can afford to be a bit of an asshole sometimes if it's gonna save a few people their savings. I can swear on your podcast, by the way, because you're over 18 now, I think. So you can put beeps over it if it helps. but like people need to be. I've been humbled many times by the market. What I'm saying now, and sometimes I might come out, I don't know, that I don't know if I come out as Noidal or something, but dude, I've been humbled by the market so many times. I'm humbled when I deal with the markets. I respect it. It's like when you swim in the sea and then suddenly there's a big wave and just takes you down. So it's the same thing. You have to respect the market and the economy. So when I hear nonsense by like promotional people, I'm like, are you serious? Do you really believe that? And unfortunately, we've been through like the last 2 years. Like you're one of the rare exceptions. And there's a lot of good young people on Twitter that have reached out to me. And I'm learning from them as well. People got sucked into really strange religions that are wealth destroying and capital destroying. And also, if it was only retail investors, it's also professionals. So it's like this disease that it's like the COVID of the asset management industry in some way, has been like embracing Ponzi's. So, that's
there are so many of them though, like especially post-COVID.
Exactly. So basically this is why, you need that cleansing and you need that thing to come out. And I was actually listening to something very interesting view on capital cycles it was one of the co-founders of Marathon Asset Management. He was saying about the capital cycle that this usually happens in a bubble where you have, in a rising bubble, the promoter knows that if he puts $1, if he raises $1 of capital, he gets back $5 of market cap. So what does he do? He keeps raising like $1, $1, $1, $1, $1 until gravity takes over. And this is the SPAC market. The SPAC market is exactly that. Like they were raising like $1, marking it up, and then dumping it to retail and hedge funds. And then the VC market, oh my God, I mean, the VC market is the biggest joke of all of them. It was like the VC market was looking at the SPAC market, and the SPAC market was looking at the VC market. They were looking at each other and saying, oh my God, you're doing well. Okay, well, if you're doing well, I'm doing well. Just like feeding each other until it just all turning to crap. I mean, I was looking, and you know, that's when you also have new actors coming in. The important thing about, one thing I always say, which is very, very important to understand, is you have to understand the game and who the players are, who's playing the game and how to play the game. And, you know, the hedge funds were looking at the venture capital market and saying, oh my God, there's a lot of money here. And also there's no mark to market. There's no mark to market, man. It's great. So they've allocated 200 billion in venture capital in the last 2 years. And that 200 billion is now sitting in, you know, Tiger Global, among others, and SoftBank and everywhere. I mean, you know, the marks on that 200 billion, dude, it's like subprime. I mean, you know, I tweeted out like in 2007, everyone was chasing yield. I remember that. Like everyone was chasing yield and buying subprime, like to make, you know, 4 or 5%. And now everyone is chasing like crypto for an inflation hedge and venture capital for it. So anyway, so that's where we are. You know, there's excess. Yeah, there's excess in the system, and they need to clear out.
Yeah. And you know, when it comes to so the other thing that I wanted to discuss is so you also do special sits, and just in general, you do a bunch of stock picking as well. So you know, when you do your stock picking, so how do you go about picking, you know, which stocks to invest? So you know, what criteria do you use in order to assess single stocks?
Yeah. So. First of all, I can afford to be concentrated, which is something that, you know, the average hedge fund manager can't really be concentrated. You know, I mean, you had a few guests, you know, like Cuppy, he plays the concentrated game very well. So if I find a big theme, like energy commodities versus short tech, I'm going to make it, you know, I'm going to make a basket of that. Well, obviously we discussed that, so put that aside. Okay, so that's the theme, and that's going to be my focus. So that's like 50-60% of my portfolio. You know, this is not a hedged trade. This is like a trade. You know, long energy mining, short tech, it's a factor trade. It's not it's not something you do at Millennium. So that's one thing. So on the special sit side, because I used to be a special sits portfolio manager, I am very particular. I'm going to play a few situations, and I'm going to, as banal as it's going to sound, I want the stocks to be in sectors that I like. And I want the stocks to have an event and an asymmetry to it and a downside protection. So actually in 2000, I was playing a lot of special sits with SPACs. I was playing the SPACs, you know, I knew it was a joke. It's fine. It's fine. I mean, you know, the event is there. So you play the event, but you watch the downside, because the SPACs were actually a great way to play special sits. Because how does the SPAC work? You know, there's an empty shell, trades at $10. Well, you know how they work. It trades at $10, and then the promoter puts a deal in, and you know, he has like 3-6 months to convince the market that the deal is great to vote the deal through. But for that period, you have a put at 10. So what I was doing, half of my 2020, was buying things close to the put and see if they ramp up. And, you know, a few of them ramped up. And, you know, I found a few that I actually really liked. One is actually one that Mike Taylor wants, was Supercycle. And I actually really liked the story, but I played it from the moment they announced the deal, a bit later, because I was doing the work on it. until the vote, and then I was out because, and then I played it through warrants. So let me just step back a bit. So the special sit is asymmetry and downside protection. So the SPAC, the unit, gives you a downside protection, but the warrants give you asymmetry because the warrants were trading at, say, 2, and the strike was 11.50, and by the time of the vote, the warrant went to like 18, something crazy. So that was multiples of my capital returned, but I was out. It was done. The trade was done for me for various reasons. There's no point going more into it. But going back to the selection, I built a portfolio of few stocks like that. And my special sits bucket is going to be like 5-6 names only. And it's going to be between 15 to 50% of my portfolio. And actually my biggest position this year was a special sits position. And it was Twitter. So I've been, just to show you again the asymmetry of the trade. So I love Twitter as a product. My favorite, the book that got me interested in investing was One Up on Wall Street by Peter Lynch. So, it was a very Peter Lynchy trade for me. It's like, man, I'm spending so much time on Twitter. I have to own some Twitter. But I was long, but I found the convertible. So Twitter had a convertible, and it was trading, at 110. So your downside is like 100. So the maximum I would lose was 10, and the upside was unlimited until 2024. And actually tweeted, the company was kind of turning around, but it was in the tech sector, so obviously it was going to get hit. But I didn't care because I had my downside protection. So I tweeted out at some point when Twitter became like overly started censoring too much its users. I tweeted out that Elon Musk is gonna buy a stake in Twitter to protect free speech. Yeah, because he knows that without free speech, he's not going to get to Mars. Yeah. Which actually makes sense. I mean, free speech is what drives society. But but at that time I was long the convertible, and this is how the special sit builds up. So you're long the stock. It's a bit sleepy there. So it was a big position, but it wasn't my biggest position. And then suddenly the guy sent that poll. He sent that tweet about the poll about vote carefully. What is it? He sent like a poll about Twitter before he disclosed. Vote carefully. This thing is happening. And I was like, dude, he's gonna buy a stake. I mean, it's obvious that he's gonna buy a stake. Yeah, he's gonna buy a stake. Why is he running a poll about this? So I had some calls on the stock, and then so I bought calls on it. It's like, it's a punt, but might as well just buy calls. And then he disclosed a stock. He disclosed a stake. So from that point, I was like, well, I know the stock very well. He sees the potential that I see, and very, very simple maths. The operating margin of Twitter is 11% and Facebook is 30%. So it's not only just because he loves to tweet. There's actually a lot of operational improvement that could have been done on Twitter. And even the ARPU, the ARPU of Twitter versus Facebook is like ridiculously bad. So I started building the position, and then lo and behold, he ended up making an offer on it. I had like a 15% position at that point. And the sad part about me is that I got everything right, including this random prediction that it's a completely random prediction. That he's gonna buy a stake like 6 months ago. And I didn't make much money out of it. I didn't make that much money because his offer was like so lowball. It's like 54.20. And I honestly thought, it was like, dude, I mean, the stock was at 70 like a year ago. So I didn't make that much money. I didn't lose money, of course, so I made some. But it's kind of like the bittersweet aspect of investing that you do, like you put on such a good trade, low downside, so well thought of, and then it's like, oh, that was it. That was it. Okay, at least we didn't lose money, but fine. And then you end up making more money on like this, this cold stock that reported like killer earnings and is up like 20%. But the thing about the special sits portfolio is that concentration works. My old boss used to say one thing. That's the first thing I remember is like, watch the downside and the upside will take care of itself. That is the most important thing about special sits. So I don't mind being concentrated. I watch the downside. I search for asymmetry. And the one thing that I'm not that good at is just keeping it for much longer. So, my timeline, probably my time, because like I have a timeline, I think in terms of timelines. So when my timeline is done, I'm kind of like, okay, I'm done. So I'm not the guy who's going to hold Amazon for 5 years. I'm not that kind of guy. I know that. It's fine.
Yeah, got it. Yeah, and to wrap up the podcast, the time has flown by. What is your best piece of advice for investors in this market?
Best piece of advice: listen to your podcasts. Have cash. So I'm going to give a few pieces of advice on this because I think it's a very dangerous market. Think about, watch the trends. Don't fight the trends. I'm going to say a few things. One is don't fight the Fed, right? We've been hearing for 10 years, man. We've been here for 10 years, don't fight the Fed. The Fed is now telling you, they told you they will tighten. And we've been buying the market because the Fed balance sheet is going up. Now they're going to shrink the balance sheet. And they told you that they need to tighten financial conditions, which includes bringing down asset prices. So if you think about, Soros's theory of, Soros's
reflexivity.
Theory of reflexivity. What did I write here? I wrote, so the way I saw the reflexivity is like you put the financial capital in and you change the fundamentals. If you take the financial capital out, you change the fundamentals. So that's QE versus QT. So keep it simple, Shrub. Don't fight the Fed. The Fed is taking away liquidity. So it means just you have to be careful that we're still above, dude, we're still above, we're still like 20, 30% above the pre-COVID levels of the market. I mean, we're not in like, it's not like buying the market in 2009 now or March 2020. Like we're still up. I mean, there's still people sitting on money. So what I'm going to say is, one is don't fight the Fed. Number two, don't fight the trend. Number three, don't catch falling knives, man. I mean, unfortunately, this piece of advice, don't catch falling knives, is very difficult for people to listen to me on this one. They will buy falling knives and they will get their hands cut off. But if you do it in small size, know what you own, look at the fundamentals, because I've looked at I'm starting to look at some tech companies. I've looked at a tech company that's down 70% because I was like, oh, maybe it's interesting. It was still trading at like 30 times EBITDA. So I don't care. So look at both fundamentals. Don't buy something because it's down 70%. That's like dumb. The difference between buying something down 80% and 90% is that you've lost 50%, right? to go from 80 to 90. So forget it. So don't buy stuff because they're down. It's like trying to date the ugliest girl in class or something. I don't know how to say it. It's that's unfair. That's unfair. She might be a really nice girl. But just spend time to understand what you're going to buy if something is down a lot. And lastly, have cash, because cash is what's going to save you in a bear market, because cash gives you optionality. This is a marathon. It's not a sprint, especially for someone like you, your age. It's a marathon. You need the winners from this point are not the guys that, we made the money in long energy, short tech, whatever. The winners, I think, are going to be the ones that come out of this with cash and alive. Because that's when you get the real bargains, the real asymmetries. You always get them at the lows. And it's when people are like given up and like disgusted. And like we've seen this so many times, there's so many examples. Not that long ago, like 2 years ago or a year ago, there were still asymmetric opportunities. But if you don't have the cash, we're not like crypto guys that just do like, oh, I bought the dip. It's like, oh, really? Where did you find the cash, man? Like this Michael Saylor guy, the MicroStrategy. Geez, I haven't discussed it to even say his name, but it's like, oh yeah, hodl, buy the dip. It's like, really? Who gave you the money, dude? Where'd you find the money? What, you printed the money? So basically, you want to survive the bear market, have cash, do smart trades, follow the trend, and be humble and be ready that what you own is going to go lower. If you thought that Amazon is going to go to like if you think Amazon is going to 2,000, it's probably going to go to 1,500. I made it up, but take the price target you have and put another 30% discount. It's probably where you're going to end up buying it in the end. So be have the cash. I just can't stress it enough. And have fun. You need to have fun. It's like if you're coming in the office stressed and you hate yourself, which I've seen many times, people like, oh, stressing about this and stressing about that. It means your portfolio is wrong, or you don't like what you do, or you're doing this for money, which is the wrong reason. So, I love what I do. I come in, if the market's down 5, up 5, still going to be happy, right? So, this is it. We got to have fun. It's the best job in the world. It's the best job in the world, and it's not even, if it's not your job and it's your hobby, it's the best hobby in the world. My job is my hobby. So, so that's a good place to be.
Awesome. Thank you so much for being on the podcast, Shrubbery. It was awesome talking to you.
Thank you so much, dude. Hope we do it again soon. Best of luck.
Yeah.
Thank you for listening to Market Champions. To never miss an episode, make sure to subscribe, and we'll see you next time.